the Federal Reserve would like to reserve the ability to always make a change right up into the minute before they have to. And so if they say they're going to do something and don't, it would be a bit chaotic for the markets. And so, the Federal Reserve Chairman Powell recently made some remarks that were very indicative of a rate cut in September.
Question on Tether, but prior to that, I said I'd rather ask first what your thoughts are on upcoming decision of the Fed. If you believe that they are going to reduce rates, and if you think that is long-term a good move.
Yeah, and first I'll just say I was very pleased to see that Bitcoin pulled back, even touched into the 40s, like 49,000 US. I was very happy to see that, because in order for Bitcoin to be on the path that it has in previous halvenings, it needed to have two capitulations between the halvening date of April 2024 and the start of the bull run, which I think will happen sometime in Q4. So I was happy to see it pull back. I would have liked to have seen it pull back a bit more. We've now had two pullbacks since the halvening. I think we're done as far as if we're looking at history as a guide, but we'll be roughly flat, and we might move 10, 15% either way. But for Bitcoin, that's not much. Throughout the rest of August and September, and then beginning in Q4, we should start to see the post-halvening bull market cycle begin. So if we start to see Bitcoin going up, and a very important thing for people to look at is the December 2024 price of Bitcoin. It would not be a good sign if Bitcoin were bouncing between 60,000 and 70,000 USD at the end of December. So hopefully it will be doing more than that. And if so, we can probably look forward to a good 2025. Now, regarding interest rates, I have been very stubbornly positioned on this. My view had been most of the economic metrics in the United States were very good, and therefore there's nothing wrong with a roughly 5 to even 6% interest rate in the United States. And historically, that would have been considered perfectly reasonable. We just got used to a very distorted period from the last maybe 20 years, since basically the 9/11 attack in the United States to the global financial crisis. We had very low rates, near zero, for a long, long time. Lots of people benefited from that, but there were people who didn't, mainly people who were saving. And so I had felt like there was no reason to raise or to lower rates since the economy seemed to be doing well. Now, this week, the Biden administration reluctantly released some data from the Bureau of Labor and Statistics, and that is the organization in the United States government that tracks a lot of economic metrics, including employment rates. And it turned out there were a lot of lies in that data. It turned out that there were nearly 1 million jobs reported as created that were fictitious.
No.
I would really like to understand who's responsible for that, how this happened. If you have a broken system that isn't reporting things correctly, you would expect that it would be equally likely to report too few jobs as too many. But the bias in this reporting seemed to be always in inflating the number of jobs, which is, of course, helpful for the Biden administration. So I think there should be a a reckoning with this data, since so much is based on that jobs data. And when you already look at the monthly reporting of jobs data as it is, almost always under the Biden administration, first comes out and it's usually way overstated. And then each month as it gets revised, we always revise prior months as we get better information. The numbers went down, they never went up. So you had that plus the fact a massive overstatement, not even included in those revisions, says to me that now we have to be much more skeptical about data coming out of the government with this administration.
So the government has recently come out with data that fictitiously is showing that 1 million jobs existed when they didn't exist.
Yeah. And what's annoying about
how did
that,
they find this out?
I don't know. I I got the data like everybody else. The Bureau of Labor came out and said, oops, you know how we've been doing all these monthly revisions where we always cut the number down 20, 50, 70%? Well, in addition to that, even those numbers that we thought had been properly corrected were in fact overstated. And the reason why, there are many reasons why this is bad. You know, we look to that data as a guide for whether or not the economy is doing okay. The Federal Reserve looks at that data. That's one of the factors that determines whether they increase or lower interest rates. Well, but in addition, you have so many millions of people who've been struggling to find a job. And then each month you see, oh, hundreds of thousands of jobs were created. So it would be reasonable for a lot of those people to think, well, I must be the loser. Why is it everybody can find these jobs and so many jobs are created, but I can't find anything? And so it probably discouraged a lot of people, this fake data. And so I hope we fix that. But it's a really good reminder that the Federal Reserve relies on a lot of information about the health of the economy in determining what to do with interest rates. But the reality is that data is never perfect anyway, because anytime you try to measure information about an entire country, it's going to be based on sampling and on estimation. Now, what you hope is that we consistently apply that practice such that if there is an error in it, there would be an error in prior periods. So you're comparing similar type of data. But this tells me that, yeah, we should be very suspect about this information. And I've always noticed, particularly with this administration, when the numbers get reported about job growth each month, the press always reports the information as though it's accurate. When, if you look, the numbers get revised up to 50% down all the time. It's a really poor gauge, that first number. They should be looking at the number maybe the third time it gets revised, presumably because it's getting more and more precise. But with that said, I still don't think the economy is doing bad. Now, maybe the GDP numbers are also a lie. Maybe the United States is becoming more like China, where you can't trust any of the financial information. I don't know yet. But if we assume it's right, GDP is doing okay. Unemployment is still, even with the corrected numbers, less than 5% of the people trying to find work. And you can quibble with a lot of that information, how it measures people who maybe have lost hope and no longer try to find a job. If you're not trying to find a job, you're not included in the unemployed, strangely, even though you are unemployed. Housing prices are still inflated over where they were pre-COVID. And inflation clearly still is a problem. This is a number that I think most normal people understand is fake. Whenever anybody looks at their expenses, which is the only inflation you should care about, and they track their expenses, buying a similar basket of goods and services year over year, in almost all cases, it's up 10, 12, 15, 20%. So it's I don't find that inflation data helpful really at all. And when it got up to almost, I think, even over 9% in 2022, after the idiotic overstimulation of the U.S. economy, it was, I think, 3 times that in actuality. But the Bureau of Labor and Statistics reduces that inflation number as it's reported through a lot of gimmicks that don't really paint an accurate picture of what an average person's expenses are doing over a period of time. So with all that said, I would like to see interest rates held where they are. But at this point, the last time I looked, the Chicago Mercantile Exchange, which tracks through the futures contracts of the federal interest rate, what the likely rate is going to be in the future. About 80 there's about an 80% based on how people are betting with their money. There's about an 80% chance that the U.S. central bank will raise rates by 25 basis points in this next meeting.
Raise rates, you said?
I'm sorry, reduce.
Reduce rates. I think if it reduces rates, so I went back to see what happens when they reduce rates after they're maintained. And almost every single time it goes into recession. But you think that everyone's doing pretty okay right now, you know? So if the interest rates go down, how is that recession going to sort of materialize?
Well,
which means they could increase rates whilst in a recession, because they've done that as well. Trying to map all this out to plot out how Bitcoin will move, basically.
Yeah. Yeah, it's a useful exercise because now crypto, particularly Bitcoin, is more tightly correlated with the overall financial markets. But I've been doing this almost 4 decades now in the financial markets. I have very low regard for the forecasting capabilities of people who call themselves economists. There are a few things I look, purchasing manager surveys, how people in corporations are thinking about adding to their inventories or shrinking them. I found that's pretty useful. Unemployment, as we've talked about, the numbers I think are manipulated. They're less and less reliable. Generally speaking, and this sounds a little strange, but most people do not cut back their spending when they are fired, when they lose their employment. They don't cut back their spending when they get a significant reduction in their salary. They cut back their spending when their view of their wealth declines. And if their view of their wealth is holding up and they're happy with that, even if their current income is not going up or is even reducing, most people don't worry too much about it. But when their perceived wealth drops, that has a big impact. And so looking at that, I see the stock market in the US is at a record high. The housing market is down from its COVID highs, but it's above what it was during or at the beginning of the COVID crisis. So I think most people who own property in the United States feel pretty good about their property, and most people who have investments in the stock market feel pretty good. So this is why I don't think we're going to go into a recession, but if we were to, I think it would be very weak recession.
Yes. So what you're saying is basically your perceived wealth is like, I'm 50 years old, I have my house paid off, I know it's gone up 10x, 15x from here. The Fed raises the rates, and in a year and a half, I'm hearing my house is worth less now. So I feel like I have less.
Yes, if that were to happen.
If that were to happen.
If
Exactly.
that were to happen,
So it's not likely to happen, I would say. I mean, keeping interest rates at stable is probably the correct way, but I think he will reduce it.
yes. All of the, the Federal Reserve, they have a way that they communicate what they intend to do. And it's a very formal process how they speak. And so it's rare, I don't know ever, if the Federal Reserve says we're doing this in advance. After they've done something, they explain why they did it. They speak in a very murky way, I think partially because the Federal Reserve would like to reserve the ability to always make a change right up into the minute before they have to. And so if they say they're going to do something and don't, it would be a bit chaotic for the markets. And so, the Federal Reserve Chairman Powell recently made some remarks that were very indicative of a rate cut in September. And today is Friday, as we are recording this, August 22nd. And the Federal Reserve and many other important financial people are at a conference in the United States where historically, at some point in the afternoon, US time, the Federal Reserve Chairman makes some broad comments about his position regarding the economy. And I think a lot of people are waiting to hear what he's going to say.
I think he did, like 20, 30 minutes ago. But,
okay, good.
But the consensus, because I watched it from a YouTuber and he was commenting on it. And he basically said, he said a lot, but he didn't say anything. So when the Fed says
Sounds
nothing,
like the Fed.
When the Fed says a lot, but in this case, didn't really say anything, and everyone wants to know if it's going down or going up.
Yep.
You think that's what is he signaling? More uncertainty, or?
What I would say, that sounds like a 25 point basis cut.
Sounds like a 25
to me.
Cut.
You know, if he had said something like, the U.S. economy has entered a difficult time very recently. Jobs growth has stopped. Home prices are starting to decline. There are a lot of people in the United States who are feeling anxious about their financial position. That would be setting it up for, yes, these are the arguments why I need to cut rates. If he's more neutral, I mean, the fact is, from a signaling standpoint, it's quite important, but let's distinguish between the signaling versus the actual real effect of something. The signaling of a rate cut would certainly imply, at least in the next couple of years, there won't be a rate increase, right? A 25 basis point cut, therefore, from a signaling standpoint, is very strong. It says we're done with this rapid rise in interest rates from basically 25 basis points to 525 basis points in about whatever that was, 18 months. So we're done with that. And now we're going to be walking it back. I suspect if the economy is holding steady, then, or even if it's in a slight decline, the rate cuts will be in the order of 25 basis points to max 50 basis points. Probably not every 6 weeks, which is when they can do it. Maybe they'll go once a quarter. As you may remember, there was in 2022, second half of 2022, 23, the Fed was increasing rates 75 basis points. I think he did that four times in a row, right? So this was extremely rapid. And people have gotten very used to these subdued rates for many years, which is why it seems bad. Many U.S. home buyers have mortgages on their homes at rates of around 3%. Historically extremely low. And as some people have commented, because when you sell your house, if you buy a new one and you get a mortgage, you have to finance that with the cost of money at that moment, which is twice as high. Many people who would like to move are stuck because their mortgage rate will go from 3% to 7%. I think the fixed 30-year for many people right now is 7%. So 3% to 7% is a very large increase. And as a result, they probably can't afford to do that unless the property values were to decline, 40%. I don't see that happening. There are a few pockets in the United States that went up ridiculous amounts. Places like Las Vegas, Florida, parts of Florida, South Florida, Nashville, Tennessee, Austin, Texas. These places saw a huge increase in the value of real estate during COVID because people were going there because they had more flexibility in how they could work. And now we've seen the last year a decline. But again, the decline still is low enough to where the prices of the properties far exceed what they were prior to the pandemic.
So knowing all of this, what is the correct hedge?
The correct hedge?
Yes.
Well, hedging involves protecting your current positions. So it would depend on what your positions are, right? If you're in property, one, you should hopefully you have interest rates that you can afford, right? That would be good. Hedging against your real property historically has been quite difficult because you could do complex things like short certain home builders in the United States that are publicly traded that will go down in price. Their stock will go down when people stop buying homes, either because they're broke or because price of homes are collapsing and people are uncomfortable buying a home when they're uncertain of where the bottom is.
But that's saying we're not there. No, we're not there.
No, we're not there.
We're not there.
I think hedging, truly reducing your exposure to the volatility of the market in whatever assets you own is generally difficult for most people. Like, how do you hedge if you're in the tech sector and you're working in AI, right? And you're getting a salary that's twice what you were getting before the AI boom. Yeah, you're probably at some risk of a pullback, I suspect. Well, one kind, not really a hedge, but where you could limit your overall exposure if the AI market were to collapse, would be to have very few investments in your investment portfolio that are AI related. Because the worst would be you get fired from your job and your investment portfolio has collapsed. So you probably wouldn't want to do that. But that, you can only do so much. I think when you own a home, a hedge of sort, I suppose, is borrowing against the home, because it's sort of like having a put option on your home. In the United States, in most jurisdictions, if you stop paying for your mortgage on your home, the lender has one of two options. The lender can seize the home as its collateral and sell it, or they can pursue their claim against you personally. They almost never pursue the claim against you personally because if you can't pay your mortgage, you're probably broke. So having a loan is sort of a way to say, if it goes up in value, I can sell my home. The mortgage provider doesn't participate in the upside of the home. Their debt that you owe them stays flat. So you get all the upside. In a downside scenario, you can walk away from the home and you're relinquished of that loan because you've surrendered your collateral. Obviously, it would ruin your ability to get another home, but it's a hedge of sorts.
Yeah. In my case, it is if you have, this is why I like the nomad life right now, because housing, I'd love to buy a house, but it's difficult to buy a house at the moment, you know, because I'm saving on a, let's say on a Bitcoin standard, you'd rather rent until you see what's going to happen. You know what I mean?
I want to dispel,
yeah.
I'd like to dispel a myth that millennials and the Gen Z generation has that is not only toxic, but it's wrong, and it will cause them to make a stupid financial decision that could wreck them. And that's this. Owning a home is a shit investment, all right? It's not an investment. It's a luxury. Owning a home is a luxury. Owning a home will almost always be more expensive than renting, even renting the home itself. There has been a huge increase in wealthy people, ultra high net worth individuals around the world, renting or leasing their properties rather than buying. And the reason is because normally it should be very close whether you would buy a home or whether you would lease the home. The financial decision should be relatively similar. That's not the case right now. Homes are grossly inflated in value right now in many parts of the world, not all, but certainly the US. And strangely, leasing that home costs a fraction of the cost of owning the home. And you're exposed to all kinds of risks, of course, with owning this home. It's a very illiquid investment. It's also incredibly expensive in the United States. It can cost 6% of the total transaction value, not the profit in what you make, but the total cost of the home in a fee that the seller pays. So it's very expensive. And I've looked at this data a long, long time. To give you a perspective, even if you bought your home in the United States in 1995, you're a baby boomer, and your home has gone up, 500%. If you look at the compound annual growth rate of the rise in homes, right? And if we take a better indicator, which would be the median price of a home, meaning half the homes are above that price, half are below. In the United States, the median price of a home has barely kept up with inflation in the United States over the last 30, 40, 50 years. In most cases, people probably do worse than that because they have to factor in the cost of selling the home, the maintenance, the property taxes, insurance. Owning a home should be thought of as a luxury. If you were to take the money you're paying on a mortgage for a home and the down payment, and you were to be investing that in like the US stock market, the S&P 500, or any other kind of US equity index that's broadly distributed like that, you would have earned with reinvested dividends 11.5% over the last 30, 20, 10 years. You're generating at most a third of that by owning a home. So there is a fantasy in the United States perpetuated by government officials and perpetuated by financial institutions and the real estate industry that home ownership is a wise decision. It's a shit decision financially. That's a fact.
I think it's
as long as you reinvest the money.
Exactly. I think now, so prior to Bitcoin, I think there wasn't much you could park a lot of capital in, if not quality property. But now with Bitcoin and it being recognized as a financial instrument, it's competing for market share, literally. You know, so it makes sense that now people are going to start saying, listen, there's too much involved. There's too much risk involved in buying a place, I think.
It's
Until
yes. I
something
mean,
happens, until something
yeah,
happens.
yeah. Buying property is I keep saying it's a luxury. There's nothing wrong with it. You want to buy a Hermes handbag, you want to buy a new Porsche, fine. Those are expenses. That's how I think about property. It's an expense.
Yeah.
And if you have to get out of that property, let's say in less than 5 years, for most people, it will have been a losing financial decision. And what happened is people, especially young people who are generally financially ignorant, they look
Patient
at
as
their
well.
parents or their grandparents and they say, "Oh, you bought a house for 75,000 US in 1980, and now it's worth 1 million," right? And they're like, "Wow, that was such a good deal." And it's like, no, that's a shitty deal compared to what you could have done had you put that money into the stock market. And by the way, had no expenses.
I think.
And even more so in the United States, for many people, they can invest money tax-free. Money that is untaxed can be put into the stock market and grow untaxed. So when you have that kind of ability, my numbers don't even account for that. It's a far better decision to lease a property and maybe when you're older, I don't know, 50 years old, if
Agreed.
you
Agreed.
want, and even then I would say why, but if you want,
Yeah.
understand it's a luxury, treat it like a luxury, and you'll do much better in planning for your financial future.
Agreed with all of that. So going back to Tether, so last
Mhm.
time when I was, you know, listening and rehearing everything, I had a question that centered around the pegging of Tether. So which it's not pegged against the dollar. It's redeemable for 1 USD. So could you clarify exactly how Tether is fundamentally backed? So how does it back that $1? Um, it
Yeah, and
has
you can
a
read a lot about it, right?
exactly.
So when I started with it, I'm no longer involved with Tether, but when I was involved with Tether, it was backed if someone deposited $1, they were given 1 Tether, which was redeemable for that dollar, right? Over time, the people who manage Tether now have diversified from strictly dollars to other financial instruments that have a interest-bearing component, so they can earn yield on those invested dollars.
The money
And
machine, basically.
mostly, yeah,
Tether's a money
mostly,
machine.
yeah, mostly it's uh, coupon-bearing instruments, sovereign debt, that sort of thing. I don't know the exact makeup because I haven't looked recently, but they do publish a report that shows the components. So it's not strictly dollars. Of course, a bank in the United States also, when it takes the money from people, it it lends out upwards of 10 times every dollar that it has in its deposits, and it puts that deposited money also in things other than U.S. currency, reverse repos, money market funds, very short-term sovereign debt.
Okay, so then my next question is, can Tether, the company, ever change their strategy to no longer be a stablecoin?
Yeah, why would you ask that though? Like, I guess any company can can either add to its product portfolio or it can change its strategy.
So,
Yeah.
when I heard that, wait 1 second. Okay, I thought I lost you. Yeah, so my question was basically when it was said that Tether is not pegged to the USD, I almost saw that like that was the safety in investing in Tether. But if now I know that Tether doesn't say they're pegged to the dollar, because that would be an incorrect way of doing it. Nothing can be pegged, like you had mentioned in the prior interview. Then is there ever a risk of 10, 15, 20 years down the line they change, you know, or is there no risk? Was this just a thought?
Okay. So I think you're asking, is it possible in the future, maybe even the distant future, that different managers managing a business could make different decisions about how they want to manage the business? Yeah, of course. I mean, when you get a new Federal Reserve chairperson in the US government, the US central bank, that person maybe focuses on different information, you know?
Fair enough.
Any company CEO comes in new, may decide to expand a product area or take away from a product area. But it's just pure speculation.
Yeah.
Could it happen? Yeah, I mean, it could happen. But you know, like anything, I assume they'll be smart and they'll expand into product areas where they see more opportunity.
Agreed. Okay, no, I was just curious about that. Okay, so I have an interesting, not an interesting, I mean, I have an opinion that if gold always has value against the fiat currency or silver in the last like 5,000 years, no, it's you could always redeem gold for something of the day.
Yeah.
Is it correct to say that Tether has become so important that it is the fiat to Bitcoin?
You could, well, people think of it as, you know, as a fiat substitute. It's simply a fiat that's been wrapped in a tokenized envelope such that it can be stored and exchanged on blockchains. So I would say most people think of it as having the same characteristics as fiat.
Okay. All right. Okay, so I have this last point, which I'm just curious to know what you think. So back in 2011, when Litecoin was released, and it was dubbed the silver to Bitcoin. So I was thinking, okay, in let's say 10, 15, 20 years time, realistically, what's the altcoin market going to look like? And
that's a tough thing to ponder.
It's a tough thing, but now there's lots of gems on the floor. Like, so if you get it right, you should get it right well for the next 15 years, because it should appreciate versus Bitcoin if it's relevant. So I was thinking Litecoin. I was doing some researching into Litecoin, and I saw that SegWit was first introduced on Litecoin, not Bitcoin, because they wanted to see how it would work on Litecoin.
Yeah, because Litecoin is a fork of Bitcoin.
Exactly.
Like all the early altcoins were.
Exactly, but it's still around. 11 years is, you can't really say it's going to go away.
Litecoin is the perfect example of what's sort of strange about crypto. Their entire development team left, I think, in Q4 2019. It was just sort of abandoned. It doesn't really do anything, yet it's perennially in the top, 20 or so tokens traded?
Top 20 tokens.
Funny, right?
Yeah, it is funny because technically, you know, it has block times, it has script hashing, it has 84 million coins. It's Charlie Lee described it as a lighter Bitcoin because you can do more stuff as well on it. It's faster.
Yeah, I mean, he just forked Bitcoin and this relaxed some of the Bitcoin constraints, which, you know, is perfectly fine. I thought it was novel for him to do that, to demonstrate that, hey, these these blockchains can be forked, and it's almost like a gaming mod, right? Where you reduce gravity by 25% or, extend playtime just to have a different environment to mess around in. And that was the thing before Mastercoin and then Ethereum came along, where people started thinking, oh, you know what? Maybe we just have an entirely different consensus mechanism that could allow us to do things that Bitcoin can't do.
Yeah, because it got me thinking, because I was watching, there was a podcast on Fred Thiel, and he recently said that Mara are mining Casper. And I said, what's Casper? And then it said it's proof of work coin that's similar to silver, or then I said, this isn't silver, the Litecoin. So I started looking at both. And I was saying, okay, if these mining companies are going to start mining proof of work coins with the intention of dumping those coins, let's say in 10, 15 years time, it's a decent strategy. So if you can maybe get on the strategy with them, it would be a good play. Anyway, I was just wondering what you thought. If, let's say, in 15 years' time, you have Tether, Bitcoin, and Litecoin all working.
So, first of all, making a prediction about anything even beyond a year is very hard, right?
It's impossible, yeah.
Probably the biggest event that we're going to be focusing on is not this halvening, but the next halvening, right? Where finally the block reward or the Coinbase will be so small, less than 1 Bitcoin, that we really need to start thinking about the post-mining compensation model for those who are offering their services and hardware to secure the network. It seems logical that it should be a transaction-based compensation model. I don't see why we can't do that. But that's a big deal. There's a lot of fossilized thinking around the Bitcoin blockchain. We've only recently seen the elements of the Bitcoin blockchain embrace something called layer 2. Wow, what an innovation. Embrace, with things like Babylon, embracing things like yield. Of course, utterly ridiculous things like NFTs minted on Bitcoin. It makes utterly no sense at all. But I think that's mostly people who are just trying to figure out a way to do something with what is otherwise pretty much a paperweight. I mean, the Bitcoin blockchain is an inferior blockchain with respect to all the more modern ones, as you would expect. And that's not an indictment of Bitcoin. It just like, Fortran and COBOL were programming languages in the 70s. And there was nothing wrong with them at that time, but we have things that, we like to use maybe more now than we did back then. So I would say if anyone is thinking of like parking some money into crypto, your time horizon, maybe 5 years. That's what I'd like to think about, and be paying attention to what's going on. And also, obviously, anything you're going to put in there should be a small percentage of your overall net worth. I have historically told people, take your liquid net worth, which should be a fraction of your total net worth, and then do 1 or 2%.
Yeah.
I think if you take 1 or 2% of your liquid net worth and deploy it into Bitcoin for 5 years, I think the odds look pretty good that you would be ahead. Yeah, but if you weren't, it wouldn't be catastrophic to you financially.
Yes, exactly. Agreed. So just to touch on that last bit of Litecoin, you think that Bitcoin, it's not advantageous for the Bitcoiner that Litecoin is around in 15 years' time, in 50 years' time?
So I do think that there is an ecosystem effect. For instance, when it was primarily Bitcoin, you go back to, I don't know, even 2012, maybe it was tens of millions of dollars a day globally that was being exchanged. Even in 2016, you're talking 100 to 200 million dollars globally on daily trading volume. And there's a correlation between the amount of trading volume and the number of tokens that are available for people to acquire. And the more things you can get into, now the whole meme coin thing, just the more overall volume is going to go up. And even, you think of the $1 to $2 billion a day volume in 2017 and compare that to, 2019, when we all thought it was a bear market and there were days where we had 15 billion in trading volume. And nowadays, well, currently it's 30 to 35 billion daily, but a few months ago we were at 100 billion a day. And so $100 billion a day volumes is only possible because there's a lot of stuff to trade. If the US stock market had one stock or two stocks, the arbitrageurs wouldn't have much to do. There just wouldn't be a lot of things that would drive trading volume. You wouldn't be shorting and so forth. Derivative markets wouldn't exist. So I think it's a good thing to have a continued growth of crypto, and also new innovations. We have a lot of today, what I would say is mostly centralized infrastructure plays. I would like to see, there'll never be perfect decentralized blockchains, but much less centralized infrastructure plays, I think, could drive more volume too. Obviously, DeFi is another one.
Yeah.
Those things tend to drive a lot of volume. Derivative markets. I mean, the spot market for crypto trading is a fraction of the futures markets, right? Futures markets drive virtually all the trading volume.
Yeah. So basically, we're gonna see it blow up, basically.
Yeah, that term, it's an awkward term, but financialization. Crypto, the financialization of crypto is a path we're just on and will continue to be on.
Exactly.
And real world assets, the trading of those at some point, I think makes sense. I would have thought it would be occurring much more than it has so far, but okay, I got timing wrong. I do think that's a trend that'll continue. Whether or not we get to, Cathie Wood's predictions of $750,000 Bitcoin or, whatever by 2030, that seems so astounding to me that it could be that big. But at that price, it would exceed the market capitalization of gold, and probably can only happen if it becomes broadly held by a large percentage of institutional investors. Right now, the Bitcoin ETFs was amazing. We're doing $1 billion a day on Bitcoin ETFs in the US on an 80 billion or so market cap of crypto Bitcoin held in the ETFs. But then you look at Ethereum, and Ethereum is 1/20th the trading volume daily right now. Ethereum ETFs do about 50 million USD daily trading volume, and about 1/10 of the market cap, about 8 billion in Ethereum. So that's interesting to me. The market cap is 1/10 of the Bitcoin ETFs, but the trading is only 1/20th, which kind of says to me that, wow, when you go from Bitcoin to Ethereum, it is an order of magnitude reduction.
Yes.
And by the way, if you were to strip out Grayscale, and it's had an Ethereum trust for 5 years, that accounts for like 70% of the Ethereum ETFs, because they now add that to the Ethereum ETFs. It's not that big. It's half that amount. It accounts for half that amount in the Bitcoin area. They're the Grayscale ETF. So there's just a lot more interest in Bitcoin and very little institutional interest in anything but Bitcoin. Whether that changes after this halving, I don't know.
I agree. I think I'm on the same camp. I mean, and even I prefer just Bitcoin. But as I'm seeing it get bigger and bigger, maybe there's something. Maybe there's a lot of gems on the floor, and you're just blinded by the gold.
Yeah. Well, we will see. And the next time we chat, we can
Yes, for sure.
see what's happened. Maybe if we
Yes.
chat in like December or something, when
Yes, I
hopefully
think
the bull market will be in swing again.
all right. So let's go with the price prediction for December. Let's say 1st December, 15 December, and 31st December. Like how?
Okay, since it's random and I know nothing more than anybody else, the way I would phrase it is Bitcoin, if we are going to be entering a bull market cycle, as we have in other post-halving time periods, then Bitcoin needs to be beginning that in Q4. Therefore, if we're stuck in a 60 to 70,000 trading range like we've been,
Not good.
it means we won't. So it needs to be closer to 100,000 USD. If it's 90 to 100, I'll feel okay. If it's less than that, I would say, it means maybe the past patterns aren't going to be happening this time around.
Which is a worrying one. I'll go for 80K. So 1st December, I'll go for 78, 82. And then I'll go for like 90, 95 at the end of the month, December.
At the end of the month. Okay. And if it does that, we're roughly in line. If it
Roughly,
does that,
if it
things are
does that,
okay.
roughly in line. Exactly. Cool.
Alrighty.
William, thanks again for this. I always learn a lot and very interesting comments. So much appreciated.
I enjoyed our conversation. Thank you.